Hi, I'm Austin Gehring with Ag360 Grain Marketing. A reminder to check out the timestamps in the description below if you want to skip through this video. In this week's podcast, we look at recent delivered and on-farm bids, potential market directions, and new app updates. Today is the afternoon of Thursday, June 26, 2025. Here's today's Market IQ report. First, we'll take a quick look at the December corn price range. Today's close marks a new low close for the last 2 weeks, 1 month, and 3 months. For November soybeans, the price ranges over the last 2 weeks and 1 month. We are trading at lows. For the last 3 months, though, we're more in the average trading range. And then July Kansas City wheat, we are trading at lows for the last 2 weeks and month. But over the last 3 months, we did see a 10-cent lower close for Kansas City wheat. Moving on to the Kansas crop insurance prices, the corn projected price is still at $4.70, soybean projected price at $10.54. Both of those will see the harvest price discovered in October. And then the July Kansas City wheat projected insurance price was at $5.90. We are discovering the wheat harvest price today, still in June, at $5.42. Let's look at the corn market and see how the market is comparing today versus similar past situations. First up, the short-term and long-term corn technical indicators are pretty weak at 0 and 16%, showing that we are potentially oversold, but that hasn't necessarily led to a bounce in prices so far. Looking at the corn, U.S. and world carryouts, the U.S. one is about at 52%, meaning half of the prices with a similar carryout to use ratio in the past were lower and half were higher, whereas the world carryout is a fairly lower percentage that shows that all prices with a similar U.S. carryout to use ratio in the past have been higher. Dollar index and inflation, we've dropped low enough that is not pressuring the market quite as much compared to the past situations, as only 62% of prices have been lower with a similar dollar index and inflation numbers. And finally, when you put that all together, trying to find all those pieces all together similar to a time in the past, limited comparisons, but it does show that no prices with that complete comparison were lower, and shows that the market could go a little bit higher at this point, but it has not done that so far. Moving on to market alerts. Market alerts are the first of 2 Market IQ tools that can be used to create a marketing plan around. As a reminder, these are sent out whether or not the current price is above or below the crop insurance price, and try to alert you when there's a pricing opportunity. Old crop alerts are for your remaining total production after harvest. New crop alerts are for your target pre-harvest sales. Thus far, corn has sent out 5 of 20 market alerts for 2025. Here's a look at recent market alerts so far this year. As I mentioned last week, it's been a downhill slide lately. Not looking best sales and amount of sales yet, and we're running out of time. But there were a few that we did manage to take advantage of. We'll look at price targets, the second Market IQ tool that's a marketing plan that you can create a plan around. Price targets are not predictions, just an action plan if reached. As we mentioned, the crop insurance price established at $4.70. We have 5 targets higher. 4 of them are now 30 cents above the insurance price that we adjusted based on weighing risk and reward and historical research. We're currently 50 cents below insurance price and 80 cents below those first targets. You can use this as a marketing plan if you'd like to only improve on the projected insurance price with your insured bushels. At this point, if you don't want to risk getting less than your insurance guarantee, you may just have to hold until you know your bushels at harvest. That's not a recommendation, just saying that there is risk in selling here, not producing, and then having the insurance price end up higher at harvest. This is today's price versus relatable report day prices. Just a reminder that past performance is not indicative of future results. Today's price is the blue line. The yellow dots and lines are relatable report day prices over the last 10 years. The red, yellow, and blue coloring in the black background tell you how many times we saw prices at that price range. Red is often, yellow is somewhat frequent, blue is less frequent. The U.S. carryout to use ratio is roughly in the middle of what we've seen over the last 10 years. World carryout to use appears the lowest in 10 years. Just briefly glancing at this chart, the most common range for corn seems to be between $3.50 and $5, though occurrences are pretty limited, so take this one with a grain of salt. Today we're just under the red, most frequent, but you can only draw so much conclusion from this chart. The upcoming June 30 stocks and acreage report from the USDA maybe adjust some of those fundamentals. So looking at the corn market outlook, here's where we're at. We've sent out 5 of 20 market alerts so far, and we've triggered 0 targets thus far. Where would we like to be at this point? Well, obviously we wish we would have sold more, had some more market alerts triggered when we were at those higher prices. There is no price target yet, as we haven't traded above the insurance price since February, so that's working exactly as it should. As I mentioned earlier, there's risk in selling here and having the harvest price end up be higher, and maybe you not producing to fill those contracts. Based on what we discussed in our market bias, what we see coming up, unfortunately, maybe steady to lower, but dependent on weather and acreage report on June 30, which are unknowns, look to make incremental sales at recent highs like at 440 or 450. Moving on to soybeans, the short-term and long-term technical indicators on the left showing 23 and 40%, meaning there's a little bit, there's not as much pressure downward as there's potential for a rebound here, just maybe a little bit overbought on the soybeans. Looking at the U.S. and world carryout to use ratio gauges, U.S. is at 4%, saying very few prices have been lower with the current U.S. situation, whereas the world gauge at 67%, saying a majority of prices have been lower. So those are fighting a little bit against each other, but good context. And then the dollar index and inflation still in the green at 78%, meaning that we've seen lower prices on 78% of the time on report days, at least, with a similar dollar index and inflation numbers. Just a note that this is a common world carryout to use ratio for that gauge. The U.S. carryout to use ratio is a lot less common and only seen during the height of the Russia-Ukraine war prices and a few other times. So maybe that gauge for the U.S. is a little bit less reliable since we don't quite have that type of world economics. But who knows in this point. So the summary gauge reading at 16%, showing most prices have been higher with all of those puzzle pieces put together compared to the past, but it may be quite hard to get that summary gauge in the green with some relatable prices during the height of the Russia-Ukraine war. So we may be a little bit quicker on triggers for soybeans this season. Moving on to the market alerts, soybeans have triggered 12 of 20 market alerts so far this year. And here's a look at recent soybean market alerts. We've been spreading them out pretty well. If weather stays good or acres increase, these will look pretty good. Last week's high we managed to take advantage of, but it remains to be seen what the rest of the season has for us. Price targets for soybeans, the crop insurance price is $10.54. We didn't reach 4 of the 5 targets yet, or really all 5, and so we've adjusted 4 of them to 20 cents above the insurance price. That's at $10.74. Last week we closed within a few cents of those targets. That'll be a good goal if some positively enters the market again. Moving on to historical soybean fundamentals and where prices have been, we have a lot more occurrences than we saw in corn. Soybeans often trade between $8.50 and $10.75 with similar U.S. and world fundamental situations. The U.S. carryout to use ratio is a little bit below of what we've seen over the last 10 years, below the average, I should say. World carryout to use appears to be a little bit above the average of the last 10 years. This is where you can really see how the confidence gauges are struggling to get a read on the market. A lot of the higher prices in this graph during the Russia-Ukraine conflict, where when we had a similar U.S. ratio, world carryout to use is comparable to past years where we see kind of some of the lower prices. We probably still have more downside than upside, but acres and weather can still be the main drivers at this point in the summer. There's been a lot of murmurs about which direction the acreage battle between corn and soybeans may go. A lot of this can change by the June 30 planting acres reports. And here's where we're at looking at the soybean market outlook. We've sent out 12 of 20 market alerts so far, and no price targets have been hit yet. Where would we like to be at this point? 12 of 20 market alerts feels pretty good, with a chance to take advantage if prices would choose to increase with a potentially lower acreage number. No price targets yet, as we haven't traded much above the insurance price since February. We did get really close last week, and maybe would have liked to take advantage of that. But there's still opportunity. Thus far, we've been trading in a range lately between 10.15 and 10.70 on November futures. That's potentially what we'll see going forward. If we can bounce back some, we may look to take action at recent highs again. But lots of factors yet in play this summer. Moving on to Kansas City wheat, the short-term and long-term technical gauges showing that the market is fairly weak as we've traded down over the last week or so at 27% on the short-term and 8% on the long-term, saying we're a little bit oversold at this point based on technicals. The U.S. carryout-to-use ratio has the gauge at 65%, saying that 65% of prices have been lower with a similar U.S. situation. 30% of prices have been lower with a similar world carryout-to-use ratio in the past. Dollar index and inflation having the market right at 50%, saying half the time we've been lower, half the time that we've been higher with a similar dollar index and inflation numbers. Putting that all together, the summary gauge gives us a 58%, meaning we're not in the green or in the red. Maybe we're kind of close to where we should be trading. We are in the height of harvest, so maybe we might see a lower number than that yet, but I hope that these fundamentals and technicals are able to keep this market afloat and give us more opportunities. Moving on to market alerts, we did accomplish 20 of 20 market alerts for this season. They did very well this year. We'll soon adjust to post-harvest sales as you figure out your total production. Let's hope these lows hold at the moment. We hit 2 price targets in February, which still look like great sales. The goal is to make sales above the June average at this point, which is currently at 541 or 542. We will soon lose the insurance floor once June ends, and then your production is open to the ups and downs of the market without any protection. Finally, we look at historical wheat fundamentals and where prices have been. Wheat often trades between $4.25 and $6.25, and today's price at $5.25 is right in the middle of that average, though you can see the red on the graph showing more prices have been below $5.25 than above $5.25 in that range specifically, but lately we've been in the $5 to $6 range. The U.S. carryout-to-use ratio is in the higher end of what we've seen in the last 10 years, and the world carryout-to-use is pretty average. So looking at the Kansas City wheat market outlook, we're at 20 of 20 market alerts, and we only hit 20% of price targets hit. Obviously, we'd want to be 100% sold on both at this point, as there were better prices earlier in the year. Based on what we discussed in our market bias, what do we see coming up? Well, I'd advise you to find out what production you end up with and look to catch upper range prices if you need to make sales in the next month or so. That has been closer to the 440, 450, but we did spike higher last week. Often in history, it takes a few months to have a chance at better prices than June or July highs, but each year is different, and know your cash flow and what your operation needs. Quick look at livestock. Cattle indicators are now showing 2 out of 3 indicators triggering, with RSI showing we've been a little bit weaker lately. We've retreated some off of highs, but as always, the indicators will help notify you when cattle returns back to recent highs or making new highs. Hogs are still reading 3 out of 3 as they were last week. July hogs were a rocket last week and jumped past contract highs by a large amount over the last couple of weeks, and we've held these highs for the last week. Looking at U.S. diesel, following the USLD New York Harbor heating oil futures, as we look for a low price, potentially indicate when it's a good time to buy diesel. The insane rally last week saw selling this week has retreated to 50% of the move. Indicators show the price is still relatively above average at this point, with 1 out of 3 triggering. Quickly here in this section, we highlight one of the Market IQ newsletter or Market IQ app areas to keep your understanding fresh and potentially have you find something new. Today, we'll highlight Basis Database found in the Market IQ app. To find these charts, go to the Basis Database section of the app, then click on the crop you're interested in. Here you can find current basis for over 300 plus locations. These basis prices are updated daily or weekly. The lists show all locations within 50 miles of your device and sort by best price with estimated trucking costs accounted for. We made a new update just this afternoon. Sometimes our app may not be synced up to the most current data. You may now see when the basis was most recently recorded for the location listed. Some locations are updated daily, as I mentioned, some are weekly. Basis numbers updated in the last day or so are colored in green. Non-colors aren't necessarily outdated, just something you may want to double check on their official websites. Dates colored in red are a week old or more. This may be due to your app needing to sync, often made by closing and opening the app and giving it a few seconds, or because I manually update them weekly and can only do them once a week. We'll look forward to removing duplicates soon. Make sure to contact us with any ideas on how to improve the Market IQ app. Here's a quick rundown of what prices we've traded for on-farm merchandising. We trade a 3 over, picked up your farm July corn bid. We've also seen 27 over delivered Wichita on November soybeans for current delivery, and then 18 under delivered McPherson on September wheat futures. Call our office if you're looking to move some bushels. Prices vary by location and are subject to change. That's all we have for today. Thank you for listening. Be sure to find us on our website or on social media. We often have a daily grain market update video posted on our socials. Contact us for more questions about anything we mentioned today, or if you're interested in any of our services. We'll see you next week.